Hi, chat. Considering the future of the UK economy and its citizens, including startup founders, what are the potential risks if the British government increases capital gains tax from 20% to 39%?
Raising the capital gains tax from 20% to 39% could have significant implications for the UK economy and its startup ecosystem. Here are some potential risks. 1. Reduced investment incentives. Higher taxes on capital gains might deter investors, especially angel investors and venture capitalists, from funding startups. This could lead to a decrease in available capital for new and growing businesses. 2. Impact on exit strategy. For founders, a higher tax rate on the sale of their business could make exits less financially appealing. This might discourage entrepreneurs from starting new ventures. 3. Talent attraction and retention. Stock options and equity stakes are common incentives for startup employees. A significant increase in capital gains tax could make these less attractive, potentially making it harder for startups to attract and retain top talent. 4. Investment behavior changes. Investors might hold on to assets longer to avoid the higher tax, reducing liquidity in the market and possibly leading to fewer exits and reinvestments in new ventures. 5. Cross-border competitiveness. The UK could become less competitive compared to other countries with more favorable tax regimes. 6. Hindering scaling efforts. Startups often rely on successive funding rounds to scale. A higher capital gains tax might discourage follow-up investments, limiting startups' ability to grow and compete on a global scale. 7. Wealth redistribution impacts. While higher taxes on capital gains are often intended to address wealth inequality, if not implemented carefully, they could have unintended consequences, such as reducing overall investment in the economy. In summary, while increasing the capital gains tax could generate more revenue for public services, it could also pose challenges for startups and the broader economy, potentially stifling innovation, investment, and economic growth.
What do you think should startup founders do?
In the face of a potential increase in capital gains tax, startup founders can consider several strategies. 1. Explore tax-efficient structures. Work with tax advisors to explore tax-efficient ways to structure your company and personal finances. This might include options like the Enterprise Investment Scheme, EIS, or setting up a holding company. 2. Plan for exits. If you're considering an exit, it might be worth accelerating your plan to complete the sale before any tax changes take effect. Alternatively, consider longer-term strategies like earnouts or phased sales to spread the tax liability over time. 3. Equity compensation. Review your equity compensation plans. You might need to adjust stock options or other incentives to remain attractive to employees under a higher tax regime. 4. Reinvest in the business. Consider reinvesting profits back into the company for growth, rather than relying heavily on external investment. This can increase the value of your business without immediately triggering capital gains. 5. Diversify investments. Founders can look into diversifying their personal investment portfolios to mitigate the impact of higher taxes. 6. Advocacy. Join or support industry groups that
Continue.
For startups. Engaging in dialogue with policymakers can help ensure that the concerns of entrepreneurs are heard. 7. Stay informed. Keep up to date with tax law changes and financial regulations. This allows you to make informed decisions and adapt your strategies as needed. 8. Incentivize through non-equity means. Consider offering other forms of incentives to employees, such as profit sharing or bonuses, which might be less impacted by capital gains tax changes. 9. Educate your team. Make sure your team understands the potential changes and how it might affect their compensation. Being transparent can help maintain trust and morale. 10. Contingency planning. Develop scenarios for how your business and personal finances would be affected by different tax scenarios. This allows you to be better prepared for changes. By being proactive and considering these strategies, startup founders can navigate the potential risks of a capital gains tax increase and continue to build and grow their businesses effectively.
What are your thoughts on founders considering to leave the country?
If startup founders consider leaving the country due to higher capital gains taxes, it could have both personal and broader economic implications. Here's what to consider. 1. Talent drain. A departure of founders could lead to a talent drain as experienced entrepreneurs and innovators move their businesses abroad. This could impact the local startup ecosystem and reduce the UK's attractiveness as a startup hub. Relocating costs. Relocating a business involves significant costs and logistical challenges. Founders should weigh these against the potential tax benefits. 3. Market access. Moving abroad might provide access to new markets and investors, but it could also mean leaving behind established networks and customers in the UK. 4. Regulatory environment. Different countries have varying regulatory environments. Founders must consider how these might affect their business operations and growth. 5. Quality of life. Personal factors, such as lifestyle, education, and healthcare, play a crucial role in the decision to relocate. Ultimately, while relocating can offer certain advantages, it's a complex decision that requires careful consideration of various factors. Startup founders should weigh the potential benefits against the challenges and impacts on their businesses, personal lives, and communities. It's crucial to approach this decision with a long-term perspective, keeping in mind the strategic goals and vision for the future of their startups.